Okay, so let's begin then by focusing on the big movers from the mid-cap space. Mangalam and Ekta from our research team are standing by. So let's start with Ethos. It's slumped in trade on the back of lower margins in Q4. Mangalam, give us the details.
Well, it's the margins which have disappointed the street this time around, because revenue is no problem. People are buying luxury watches, and how 31% jump in the company's top line. In fact, it's coming at around 207.5 crores, which is the highest that we've seen on a quarterly basis for a very long time. In fact, the EBITDA, however, grew just 20.7%. That meant that the margins compressed by about 100 basis points year on year, and as a result of which the net profit too has come in at 13 crores versus 7.8 crores. A large part of the net profit growth also can be attributed to higher other income, which is coming at around 5 crores versus 1.9 crores itself. Now, margins, while they've compressed about 100 basis points year on year, if you just take a look at the trend over the last few quarters, the margins are nearly at a 4-quarter low. Margins in the first quarter of FY23 were close to around 16%. Then they've gone all the way down to around 12%. So from the highs in the first quarter, it's a compression of nearly 400 basis points. A large part of that could perhaps be attributed to the reduction in growth rate of average selling price as well, because average selling price in FY23 grew by just about 7%. This compares with 35% in FY22 and 31% in FY21 itself. So watches which sold at an average price of 84,000 in FY20 increased to 1.1 lakh in FY21, 1.49 lakh in FY22, and now it's 1.59 lakh itself. And the last reason why the stock could be lower is also on account of profit taking. In the last 6 months or so, the stock has rallied about 50% given the boom in India's luxury market. So mild miss on the margins and a big run up in the stock has led to a bigger decline in today's trading price.
Okay, thank you very much for that. And now